Welcome, everybody. This is Robert Keens with Gold Silver Pros, back with a very special first-time guest of the program. I'm here with David Hunter of the Contrarian Macro Advisor. David, how are you doing today?
I'm doing great. Thanks for having me, Rob.
Yeah, absolutely excited to have you on the channel. I've been listening to a lot of your interviews recently and following a lot of what you've been speaking about, and I think it aligns with some of the views that we have here on Gold Silver Pros. So I wanted to bring you on so our audience could take a look at your work and listen to some of your opinions, if you don't mind.
Sure.
So explain basically what is, before we get started on the question and answer, what is the Contrarian Macro Advisor and what do you basically cover?
Yeah, Contrarian Macro Advisor is me, essentially, and I'm a macro strategist covering, the markets and the economy. So I do the stock market, bond market, some of the currency market, the metals markets, commodities, pretty much anything macro. And I've got some, I would say, very contrarian views on the economy and where we're going, not only this year, but over the course of, the balance of the decade.
Okay. And I was listening to an interview you had on Palisades Gold Radio with Tom this morning. I believe you recorded that or it came out on April 21st, and you were speaking about the economy. So let's get started there. What is your view long-term on the economy? Where do you see us being? Are we at the end of this big stock market bull run that we've had over the last 10, 11 years, or where do we sit right now?
Sure. Yeah, I am out there saying that this is the end of a 39-year secular bull market. And I date it back to 1982 simply because that was kind of the start of disinflation. We peaked inflation in the 81-82 period. And then over the course of the last 4 decades have ratcheted inflation down to where it got to essentially zero. Now we're seeing it move back up and rates have followed all of that. So it's been really, with inflation coming from 20% down to close to zero, interest rates followed and market multiples are the inverse of interest rates. So you basically have had 40 years of wind at your back with PE multiples moving up because inflation and rates were moving down. So that's the essence of why I think the secular bull market started in 82. I could date it back to 74 because we had, a lower low back then and then higher low in 82. But I'm really tying it in with the disinflation. And so my view is we're in the last year of that 39-year secular bull, and in the end part of a big long cycle like that, the market will tend to go parabolic at the end, and I think that's what we're seeing. Certainly we've had quite a parabolic move from March if you step back, but I think it's going to even get steeper here in the next couple months. So I'm looking for 4,700 on the S&P, probably second or third quarter. So it could still happen if it happened fast in the second quarter, but more likely probably spills into the third quarter. And then on the other side of that, and so this is the end of an economic cycle that started in 2008-9, of course, or started in 2009. But I'm looking on the other side of that for a deflationary bust. So we likely, I think, starting before this year is out, begin what I define a bust as something that's perhaps as bad in many ways as a depression, but more the speed of a recession. So I think it probably gets contained pretty much through 2022. But it will be the first deflationary downturn, global deflationary downturn, in my opinion, that we've seen since the Great Depression. Will be fast. We won't. It's not like a drawn out 8 or 10 year deflationary period. Probably be contained, like I said, within 2022. So then we start a recovery cycle by 2023, and I think that recovery cycle will be an industrial-driven, inflation-driven cycle. So unlike the last 40 years that have been consumer-driven, disinflation-driven, or disinflationary, this one will be more what we're seeing now, where it's going to be, commodities and industrial will start taking the lead. And I think this is kind of a wild call, but I think in that period, 23 to 2030, you could see interest rates and inflation retrace to the last 40 years. So you could be back to 20% inflation rates and 15% long bond within 7 or 8 years, and maybe less. And simply that's driven more than anything by this massive monetary response from central banks.
Yeah, I wanted to ask you about that because I know you've talked before about the Volcker area, and prior to the Volcker area, what led up to Paul Volcker and his response to inflation. What, do you see us going into that same type of situation where it's high inflation? And if so, is it the Fed's policies?
For sure. And Fed, and I think this is global, so it's basically every central bank's pretty much mirroring the others. So yeah, very much as I say, I'm one of the dinosaurs that's still around from the 70s. I was there when G. William Miller was Fed chairman under Carter, and I saw him make huge mistakes where he made the mistake. Keynesianism was very big back then, and he made the mistake of targeting rates, thinking that he was being tight because rates were going up, in the late 70s. But they were going up a lot slower than the inflation was going up because they were putting money into the system to keep rates somewhat subdued. And so he was mistakenly thinking, well, rates are going up, I'm tightening, when in fact, they're pouring fuel on the fire with a lot more money. And that's what, by 1980, created the situation where Volcker had to come to the rescue. And, by the time Volcker came in, and what Volcker did simply was change from targeting rates to saying, I'm gonna let rates go where they have to go. I'm tightening down money. So he clamped down on the money supply, and rates spiked from the long bond spiked from 9% to 15% almost overnight. And that's what I think we're headed for again. We'll have a mini version of that, I think, later this year. With what Jay Powell's doing. He keeps talking transitory. I think by the time we get to the fall, maybe it happens sooner, he's going to have to abandon transitory and say we've got to do something about this. But that won't be. We'll be dealing with 4% inflation, not 15% or 20% inflation. So it's a mini version of that. But I think because of the fragility of the system, a lot of it because of the pandemic, but also because of all the leverage in the system, I don't think it's going to take very much tightening to unwind, to cause an unwind or rollover in both the market and the economy.
Yeah. And getting to your comment about Powell mentioning transitory, do you think he's using transitory to sort of manage the market a little bit here? And do you think they really know that the potential inflation problem they have on the horizon is worse than what they're letting on?
Yeah, I'll say this. I really believe, and I was probably one of Jay Powell's biggest critics back in 2018 and 19, because he was behind the curve. And I kept saying, this guy isn't even an economist. He's really learning on the job. And, I was very much against the tightening that they were doing in 2018. But I will say, March of 2020, he stepped up. He had learned a lot in the past 18 months, and he did what he had to do and did it fast. So and ever since then, I've been pretty much have had his back in terms of saying, I think he's doing what he has to do. If he didn't do this, we'd all be living in caves. It's all these people out there, and I particularly say the Austrians that want to pick on the Fed and pick on Powell. It's a nice theory, but guess what? If you really clamped down and had a monetary rule or whatever, this thing would go straight down, and you wouldn't be able to pull us out of it. With $250 trillion of debt sitting over this economy, you just can't kind of ignore those things. So it's not something he chose. It's not something he created, but he's got to manage it. And I think he's doing, given the circumstances, I think he's doing a reasonably good job. And I really think he's being transparent about what he's trying to do. We're so used to the Greenspans of the world and a little bit the Bernanke's, feeling like they couldn't tell you what they were doing or else it would defeat the purpose. He's really been very transparent, and I think he believes what he's saying, which is that number one, some of at least a good chunk of the inflation is transitory due to the supply chain, et cetera, and that we have to get unemployment down. That there's still certainly 8 million and maybe as much as 20 million that are both unemployed and underemployed. And he's, I think he's correct that, you've got, it's not going to get there by itself. You've got to help it along. The problem is, yes, he's right. Some of it is supply chain and some of it is transitory. Some of this, though, is just there's very strong demand because of all the monetary and fiscal stimulus. And we've spent decades, frankly, kind of cranking down commodity production around the world, and all of a sudden then you ramp up demand. It's not a good combination. And so I think you can use semantics and all you want, but it's real inflation.
Yeah, I want to ask you about two things. I know the Fed has been talking about potential yield curve control, and I know you have an opinion on whether that would work long term or not. And then the second question was on Yellen's comments about we need to increase taxes and increase spending, and I read that as sort of more of a move to socialist policies. What are your thoughts on both of those topics?
Yeah, she's certainly talking out of the the Democrat hymnal and the Biden hymnal. So she's doing her job, I guess. But it'd be disastrous policy. It's probably coming. But as I say to people who say, well, and when the market reacts to Yellen, I go, but Yellen's not Fed chairman, so she can talk about things, and she's doing her job in terms of being, answering questions and speaking. But in terms of monetary policy, that's Powell's job. In terms of taxes, for sure. I mean, we know where the Biden administration wants to go. Hopefully, some of that gets moderated by some kind of bipartisanship in terms of when they put this together. But I am obviously not a supporter of that. I think anytime you raise taxes, particularly to the levels they're talking, it's gonna defeat the purpose. You'll get less revenues. You'll see a weaker economy and more unemployment. So I don't agree with it, but I know what we're dealing with, and I just hope we can kind of head off some of it at the pass. I forgot the rest of the questions.
The yield curve control by Powell. The Fed can control yields.
Yep, the yield curve control, as I say, is in the long run, it's a myth. And frankly, even in the shorter run, I don't think it has as much capability as people think. The market controls rates, and particularly even in the short run, if you have inflation pushing up here, and we just saw it in the last 6 months, if the treasuries are going to start selling off, the Fed buying treasuries isn't going to stop that. There's, the market's too big, so they can kind of influence it when everything's kind of modestly changing or stable. But when you get into a situation where inflation's starting to roar away, they're going to have to deal with that, or else it's pay me now or pay me later. And I lived through that with G. William Miller. They thought they could control the yields, and they found out very quickly, unfortunately too late, that it's like trying to manage a forest fire by pouring more gasoline on it and saying, yeah, but we're not pouring as much gasoline on it as you think we are. Well, guess what? Gasoline really fires it up. So I just think when people put out YCC, I just go, it's a myth.
So you said earlier that you think the market could top out sometime either late second quarter, early third quarter, and then we would have a reversal down. Being a contrarian, what are your thoughts on some safe havens? Where can people go to avoid that market downturn?
Yeah, I have to be careful that I tread carefully and not get into advice. So what I can say is that when first of all, I believe leading into the top, the leaders that got us here are going to continue right into the top. So I think, and this is contrary right now, but I think tech, including the FANGs, are gonna have a big run right into the top. I think semiconductors will be part of that. All of tech should play pretty well. I think materials, I think industrials will also play, along with miners, et cetera. So it's not just tech, but in fact, I think we're going to have a fairly broad rally right into the top. When you get into the rollover, and what I call a bust, I think the two assets that will, and by the way, I'm calling for an 80% bear market, so it's not a small thing. I think around the world, there are two assets that I think will stand up and hold their own, probably appreciate, and that is treasuries and the dollar. And I'm bearish the dollar right now, but in the bust, I think it will get that flight to safety bid. So I'm calling for a dollar down to 85 and probably down to 80 here in the next few months. Okay. And then from there in the bust, whenever the bust hits, whether it's fourth quarter this year or whenever, in the bust, I think the dollar will go from 80 back to 120, maybe higher. And I view that as kind of the last hurrah for the dollar in terms of it'll make a high and probably not see that high again. But so the dollar will do very well in the bust. I think I'm calling for a 2.5% 10-year, 3% 30-year this year in the tightening. First rally here, I'm calling for 120 10-year in the next couple months. But if we get to 2.5 on the 10-year in tightening, I think we'll go to 0 in the bust. So, you'll see the 10-year drop to 0 and the 30-year drop to a quarter or something like that. So obviously treasury bonds do very well. Not all bonds. I think pretty much anything below treasury grade is going to see spreads widen and so not do well. But those are the two, along with FDIC insured savings accounts, the three assets I think will hold value. Beyond that, if you're going to have an 80% bear market, it's pretty much everything goes down. As I say, the metals, because I'm looking for a rally here in metals, gold to 2,500, silver to 50. In the bust, they'll probably back off, maybe, pull back 30-year, maybe even 40%, but it'll be, still relatively a much better performer than the overall market.
Okay, so metals do well. Maybe the dollar does pretty well. Bonds, you think will do well as well. What do you think happens to people's investments in the pensions, other stock investments, people who are in those qualified investment accounts? What is their move here? Because if we're talking about 80% downturn, that's a pretty big downturn. What do you think is going to happen with those pension investments and those longer term savings?
Yeah, people are going to have to figure it out with their advisors or what have you. But what I will say is, this is going to be, in my opinion, if I'm right, the worst bear market in the post-World War II era, the worst since the 29 bear market. So, obviously, it's going to take no prisoners. I think most pension funds are going to be in trouble. They're already very underfunded. And, unfortunately, they've made the move into private equity, thinking private equity is non-public equity, so therefore more stable. And as I say, in the 1980s, what we call private equity today, we used to call leverage buyouts. Leverage is not something you want in a worst economy and 80-year type environment. Right. And that's, I think that's going to be part of the problem, is that they've diversified, but they've diversified into areas that could be even worse than equities, or at least as bad.
Based on your thoughts on the dollar, maybe going back up and reaching 120, do you think it's the best of a bad bunch of currencies? And do you think we see maybe in this downturn, some foreign currencies start to fail?
Yeah, I actually think the euro may not make it. I mean, that's a bold forecast, and I have no inside information, of course, or no reason for saying that other than I think Europe is, last time in 2008-9, we were kind of the leader of the downturn. We subprime and all our problems here kind of took everybody else for the ride. This time around, I think Europe is in much worse shape than we are, their financial system. And I really question whether the euro can withstand, this kind of a downturn and this kind of a market crash when you've got such changes from, such diverse situations from Germany to Italy to Spain and everything in between. So I think we may, certainly Euro's going to get tested big time, and I just question whether they can make it. They may have to go back to individualized, sovereign currencies. And then, who else besides the dollar is, positioned well? I don't think any, Canada's where we were last time real estate wise. And I think economically and their banks are more leveraged now. That last time they were in much better shape. Australia's kind of similar story. Asia in general, China's leveraged to the hilt. We all know that. So I just think this is a global problem. The dollar's, the cleanest shirt and the dirty laundry, but it's not because the dollars or because the U.S. is in great shape. We're not. And I think this is, like I said, it may be a last hurrah. The response to the bust is going to be money like we've never seen before. I fully expect the Federal Reserve balance sheet to be 20 trillion or higher. And I think you'll see proportionally similar in every central bank around the world. And that's what triggers the inflation cycle, the true inflation cycle that follows this. But, I don't see that as a good thing for the dollar.
I want to ask you about the energy commodities complex. We've seen some inflation in a lot of the energy so far this year. It's one of the leading sectors in the Bloomberg Commodities Index. Of course, oil, natural gas have all seen sharp increases. What do you think happens to them after the downturn? Do you think we have an overall deflationary move in the prices of those, or do you think that it just launches higher?
Yeah, I'll get into a shorter term talk about oil, but just to answer that, I am calling for probably, later this decade. So in the 2026, 7, 8 period, I expect oil to be north of $300 a barrel. So I fully expect oil to be one of the leaders of the next cycle. Commodities in general are going to be the big leaders of the next cycle. And I would say you could see $10 again in the bust. So it's going to be quite a roller coaster ride. I'm actually calling for oil to fall into the low 50s here. That, we kind of double topped yesterday. The highs of this, this move out of the zero level of this past year. And, it's run up, it ran up to the high 60s or mid to high 60s, and it double topped yesterday. I think you're probably set up here for a period where oil heads back, whether it's 54, or whether it's 50, or it might even undercut 50, somewhere in there. I think the run up just didn't, this last run up, after it pulled back first time a month or two ago, was all driven by the pipeline fears and, gas lines and all of that. So I just don't think fundamentals are such that it should go higher here. I think it should go lower first. May make another run later in the summer when I think we get the final inflation push of this cycle. You could see it up to 75, I think, before it rolls over. And then in the bust, I wouldn't be surprised to see it back at somewhere between $10 and $20, just because we're going to have a really bad global economy. But then from that, starting second half of 2022 or later in 2022, I think you start a long climb that'll take it ultimately And I say 300 plus. I don't know whether 300 plus is 350 or 500. I have no idea. I mean, I think we're going to see some wild prices in commodities. We're kind of getting a mini version of that right now in terms of, supply issues.
Yeah, we are. And it's not helping that we have a pipeline from the Gulf Coast to the East Coast that stopped working. There was a ransomware hack on it. I was actually out in Virginia when it happened, and we were worried about being able to get to the airport. We were out of gas in the rental car, but we ended up making it. And I had friends as far as north as New York who was saying they were having gas shortages up there as well. So that, of course, didn't help the issue. I wanted to go, the last question I want to ask you is about 2020. So 2020 saw the pandemic hit around the world. We saw a lot of restrictions, a lot of closing down of government, closing of mines and other industrial centers. And we saw a creation of 40% of all the liquid US dollar cash ever created in history in 1 year. What do you think that effect is going to have on this downturn? Do you think it's amplifying it? Do you think it's causing it? Or what role did 2020 have in what you're saying is going to be the next big downturn?
Yeah, I think it's certainly a big factor in what's coming. It's kind of the perfect storm, and frankly, as I say often, this didn't happen overnight. This was 40, 50 years in the making, and we want to point at central banks and particularly the Fed as to blame, but we're all to blame. I mean, it's revenue sharing in the government. It's politicians spending money like drunken sailors and not worrying about how it gets paid back. It's credit card debt so we can live for today. It's buying big houses because we can have a low mortgage payment and afford it. It's all the stuff that has led to this idea that you live for today and don't worry about tomorrow. So I think, and then a pandemic hit, and we were just so leveraged that it was easy for that to take its toll on everything. But yeah, I mean, it's going to be part of the story in terms of the bust. What it really does is it causes us to be doing things that are unprecedented in terms of fiscal and monetary response. And if you thought the response was big in the last year, wait until the bust hits, because our central bankers here, as well as Bank of England, ECB, China, et cetera, it's going to be deer in headlights time. They're just the reason I say the easiest prediction I can make is the response to the bust. They will have no choice. You can't, even though our government has shown they can spend money pretty fast, when you have a free falling financial system, and I mean free falling, major bank failures, et cetera, happening day after day. The only policy tool they have that they can roll out very quickly is money. So you will see initially, just like you saw in March, the first thing that happens is going to come from the central banks. Then you'll see the government get their consensus building act together and put together major fiscal stuff that will match what the monetary is. But the first thing that's going to come is money. And the first many trillion that the Fed shovels out the door isn't going to stop anything. So they come with another several trillion. Doesn't stop anything. And there's a lag to when anything happens anyway. So it's pretty predictable that if it took moving from 3.5 trillion to 7.5 trillion for what happened at last March, it's easily going to go from, let's say, 8 trillion to, it could be 20 or it could be 30 trillion. Because I think we are looking at a system that will look like it's totally collapsing. Major banks are going under. They'll declare moratoriums. They'll do everything they can to keep the system intact, but it's not going to feel like that for a period of time, whether that's months or weeks or months. But it's going to be a period where the central bankers have no playbook for this. They have a little bit of it from March, and that was they drew on what happened in the last one. But all this stuff is, I think, the result of not only are we in the 39th year of a secular bull market in stocks, we're in what I call a super cycle, which is, as I define it, the big cycle, the long cycle between two depressions, the 1930s being the last depression, the 2030s probably being our next depression, because this bust is not the depression. That's where I differ from, some of those gloom and doomers out there that say we're down for the count whenever this rolls over. Because we have low inflation and ultimately, I think, deflation in the bust, that gives central bankers almost an infinite ability to print money. So that gives you one more recovery cycle. The problem is when you get to the end of the decade after the inflation cycle, or at the end of the inflation cycle, you're going to have 20% inflation rates and maybe higher, and interest rates up there. And you're going to have maybe, instead of 250 trillion, maybe 400 trillion in global debt because of what the response is to the bust. I can't answer the question even on the way there of how the U.S. can afford to service its debt if we run into that kind of an interest rate move. I have no answers for you other than initially they're going to be floating debt to pay service costs. But that ends pretty quickly because the capital markets will say, no thanks, we don't want your debt. So that's why I think the next cycle is going to be very steep, but pretty fast. I don't think it can be drawn out for 8 or 10 years.
Well, thank you so much, David, for stopping by the program. I know you do a quarterly newsletter and you're also on social media. So if you'd let people know how they can reach you and they can get access to your newsletter if they're interested.
Sure. I'm on Twitter. You can reach me at Dave H. Contrarian is my handle. And I do have a quarterly investment letter. It's all macro. That if people are interested, just direct message me on Twitter and I'll give you details.
Okay. Fantastic. Thank you so much for stopping by the program. We appreciate all the information you've given us today.
Yeah, thanks, Rob. Thanks for having me.
Yeah.